Good morning. Thank you all for coming. I'm Doug Elmendorf, the Director of the Congressional Budget Office. CBO's mission is to provide Congress with objective, nonpartisan analysis of budget and economic issues. Part of the way we fulfill that mission is to prepare regular budget and economic outlooks, the latest of which we released this morning. I will briefly summarize the report, and then my colleagues and I will be happy to take your questions. Let me begin by noting that our baseline economic and budgetary projections are conditioned on current law, not because we expect that there will be no changes in law, but because this approach provides a benchmark against which potential changes can be measured. What we are presenting is a benchmark, not a forecast. That distinction has a big impact on both the economic and budget projections. What is our assessment of the economic outlook? As you know, the pace of the recovery has been slow since the recession ended 2.5 years ago. And we project that it will continue to be slow for the next 2 years, reflecting both the lingering effects of the financial crisis and recession and the fiscal restraint that will arise under current law. Specifically, current law fiscal policy will reduce the growth of output slightly in 2012 and significantly in 2013 through a combination of large tax increases and large spending cuts. Our projections incorporate the upcoming expiration of the payroll tax cut and emergency unemployment benefits, the expiration of the tax cuts enacted in 2001, 2003, and 2009, as well as other expiring tax provisions, the constraints on spending imposed by last year's Budget Control Act, and the winding down of the budgetary effects of the 2009 Recovery Act. Taken together, those policies will generate a sharp fiscal contraction. In addition, the excess number of houses, loss of wealth, run-up in debt, and other legacies of the economic downturn are continuing to weigh on household and business spending. As a result, and shown in the slide, CBO projects that real GDP will grow by only 2% this year and only about 1% next year. We expect economic activity to quicken after 2013, but real GDP to remain below the economy's potential through 2017. According to our projections, the economy is only about halfway through the cumulative shortfall in output that will result from the recession and its aftermath. The costs associated with that persistent output gap are immense, and they are borne disproportionately by people who lose their jobs, who are displaced from their homes, or who own businesses that fail. In particular, the labor market still has a tremendous amount of slack, mainly as a consequence of continued weakness in the demand for goods and services. In CBO's forecast, the unemployment rate remains above 8% both this year and next. As economic growth picks up after 2013, the unemployment rate will gradually decline. But in our projection, it remains above 7% until 2015, before dropping to 5.25% by the end of the coming decade. While the economy continues to be weak during the next few years, inflation and interest rates will remain low. Let me turn now to our budget projections. Under current law, we expect that this year's deficit will be about $1.1 trillion. At 7% of GDP, that is nearly 2 percentage points less than the deficit recorded last year, but still larger than any deficit between 1947 and 2008. Over the next few years, projected deficits in CBO's baseline narrow sharply, as you can see in the picture, averaging 1.5% of GDP and totaling about $3 trillion between 2013 and 2022. With deficits small relative to the size of the economy, debt held by the public drops a little as a share of GDP in our baseline projections, but remains quite high. Much of the projected decline in the deficit occurs because, under current law, revenues will rise considerably. In particular, between 2012 and 2014, revenues in our baseline shoot up by more than 30% because of the recent or scheduled expiration of various tax provisions and new taxes and other collections that are scheduled to go into effect. Federal spending in the baseline declines modestly relative to GDP in the next few years as the economy expands and statutory caps constrain discretionary appropriations. Later in the decade, though, spending turns up again relative to GDP because of increasing expenses generated by the aging of the population and rising costs for health care, and because the accumulation of debt and rising interest rates will cause a surge in the government's interest costs. Of course, these baseline projections are heavily influenced by the changes in tax and spending policies that are embodied in current law. Changes that in some cases represent a significant departure from recent policies. To illustrate the budgetary consequences of maintaining some tax and spending policies that have recently been in effect, CBO developed projections under an alternative fiscal scenario. That scenario incorporates the following assumptions. First, that all expiring tax provisions other than the payroll tax reduction are extended. Second, the alternative minimum tax, or AMT, is indexed for inflation after 2011. Third, Medicare's payment rates for physician services are held constant at their current level rather than dropping by 27% in March and more thereafter, as scheduled under current law. And fourth, the automatic spending reductions required by the Budget Control Act, in the absence of legislation reported by the Joint Select Committee on Deficit Reduction, do not take effect, although in this scenario the original caps on discretionary appropriations in that act would remain in place. Under that alternative fiscal scenario, deficits over the 2013-2022 period would be far higher than in the baseline, averaging 5.5% of GDP rather than 1.5%, and totaling $11 trillion rather than roughly $3 trillion. Under this scenario, debt held by the public would climb on an unsustainable path, reaching 94% of GDP by 2022, the highest figure since just after the Second World War. Under that scenario, the economy would be noticeably stronger during the next few years than under current law. Noticeably weaker later in the decade. Reflect the uncertainty involved. The midpoint of the ranges for the end of 2013 showed GNP under the scenario that is 2% higher than under current law, and an unemployment rate that is 1 percentage point lower. However, the midpoint of the range for 2022 shows GNP that is more than 2% lower under this scenario than under current law because of the crowding out of investment that would be caused by the escalating debt. It bears emphasis that projecting economic outcomes and the budgetary outcomes that would result from them is very difficult. Many things could cause the economy and the budget to turn out better or worse than we project. However, there is no plausible economic outcome under which the policies of the alternative fiscal scenario I've just outlined would lead to a sustainable budget outcome. The fundamental fiscal challenge for this decade and beyond remains the aging of the population and rising costs for health care. The number of people in this country aged 65 or older will increase by 1/3 in the coming decade, substantially raising the cost of Social Security, Medicare, and Medicaid. In addition, the Affordable Care Act will significantly increase the number of non-elderly people receiving assistance through federal health care programs. Furthermore, CBO projects that the costs per enrollee for Social Security and the major health care programs will continue to rise. Because of these forces, the set of budget policies that were in effect in the past cannot be maintained in the future. Here's one way to think about the problem, using CBO's projections under the alternative fiscal scenario, which, as I've said, represents a continuation of many recent and current policies. Each pair of bars represents a component of the federal budget as a share of GDP, with the left bar of the pair showing the average during the past 40 years, and the right bar our projection for 2022. Under this scenario, outlays for Social Security and the health care programs, the first set of bars, would be much higher in 2022 than in the past. However, outlays for all other federal programs put together, the second set of bars, are projected to be about 8% of GDP in 2022, below any year in the past 40 years, and well below the 11% of GDP that such outlays have averaged over that period. Yet the budget deficit under this scenario, shown on the far right, is projected to be 6.1% of GDP in 2022. To keep debt from rising relative to GDP, the deficit would need to be about 3.5% of GDP smaller in 2022 than we project under this alternative fiscal scenario. That's $900 billion of reduction in the deficit relative to this scenario in that year, 2022 alone. Therefore, to put the budget on a sustainable path, policymakers will need to allow federal revenues to increase to a much higher percentage of GDP than the average of the past 40 years, or make very large changes to Social Security and federal health care programs, or pursue some combination of those approaches. Let me close by highlighting the consequential choices that policymakers face this year. On one hand, if policymakers leave current laws unchanged, the federal debt will probably recede slowly relative to the size of the economy. That will occur because of a large increase in revenues and sharp restraints on federal spending, apart from the largest programs. However, both of those changes from historical patterns will have significant economic and social effects. Moreover, the sharp fiscal restraint this year, and especially next year, will markedly slow the economic recovery. On the other hand, changing current laws to let current policies continue along the lines of the alternative scenario we've outlined would boost the economy and allow people to pay less in taxes and benefit more from government programs in the next few years, but would put the nation on an unsustainable fiscal course. If policymakers wanted to achieve both a short-term economic boost and medium-term and long-term fiscal sustainability, they would need to enact policies that leave deficits significantly wider than we project under current law for the next few years, but significantly narrower than we project under this alternative fiscal scenario for later in the decade. In conclusion, how much and how quickly the federal budget deficit declines over the coming decade will depend in part on how well the economy does. Probably more critical, though, will be the choices made by lawmakers as they face the substantial changes to tax and spending policies that are slated to take effect within the next year. Thank you. We're happy to take your questions. For everyone's benefit, please identify yourselves and the organization for which you report. We're all yours. Yes?
Yeah, Andrew Taylor, EAP. Your alternative fiscal scenario does not address the payroll tax issue, is that correct?
That's right.
Can you give your estimate as to what would happen if the payroll were extended through the end of the year as the President wants?
Yes, we provide this in the report. If the payroll tax cut were extended for the remaining 10 months of 2012, it would add about $75 billion to the fiscal year 2012 deficit and about $25 billion to the fiscal year 2013 deficit. Because, of course, fiscal year 2013 starts in the last quarter of this calendar year.
And the effects on the economy?
We have not reported that here. I think the part of the restraint, part of what is holding down GDP growth in our baseline projection is the expiration of the payroll tax cut. I think if that were extended for the rest of the year, we think it might add about 0.5% to the level of GDP, 0.25% to the level of GDP at the end of 2012.
And unemployment?
The effect on unemployment would be around half of that, so maybe a tenth or two on the unemployment rate.
Do you have a projection for the unemployment rates going forward?
We do. So there's summary data on the economic forecast in Chapter 2, and then year-by-year tables in Appendix E, if you look on pages 128 and 129. So we show the average of the unemployment rate in each year over the coming decade. And we expect that to decline slowly, principally because of slow growth in the demand for goods and services, and thus slow growth in businesses' need for employees to produce the goods and services they're selling. in addition to the limitations on the demand for workers, we think the unemployment rate is also being held up by some structural factors, mismatches between the available workers and available jobs, the effects of the extensions of unemployment insurance, and some other factors. We think those are a comparatively small part of the current amount of unemployment, but we think that they will persist to some extent through the decade. Our unemployment rate that we project for the end of the decade is a little higher now than it would have been in the absence of recession and prolonged high unemployment. Yeah, Darren.
Darren Gershon, I think Business Report. How much, following on that, how much do you see potential GDP coming down? I mean, and how much are you lowering your outlook for the long-term growth capabilities of the U.S. economy?
So we have a box in Chapter 2 of the report called The Lasting Effects of the Recent Recession and Potential Output. Our current estimate is that potential output, and thus actual output in 2022, is about 1.25% below what it would have been without the financial crisis and the recession. We think of that as being partly smaller capital stock. Businesses have done much less investment in the past few years than they would have without this downturn. They will make up for some, but not all of that, by the end of the decade. We think that some of that loss in potential output is through lower labor supply. People who have lost jobs will either leave the labor force or remain in and not be able to find work again. And we think part of that is a little hit to productivity growth, of the productivity of those labor and capital resources. There's a wide range of possible long-term effects. I think one of the risks in our forecast is that this prolonged period of high unemployment and prolonged period of high long-term unemployment for individual workers could have a larger effect on output in the long term. We have not had a period of such persistently high unemployment in this country since the Depression. We just don't know how workers and firms will respond over time. I think we've made the best estimate that we can, but that's a source of significant uncertainty.
How much does that estimate impact the deficit projections? Is it significant or not?
It raises the deficit. I don't think it's a huge amount. We show in our another part of the report rules of thumb for the effects of changes in the economy on changes in the budget. So 1.25% on the level of GDP at the end of the decade is a little more than 1/10 of a percentage point on annual GDP growth. And we show in the appendix that if you lower economic growth, I think about $300 billion to the deficit over the decade. But of course, one thing, and I will move on, the slow recovery, the fact that output remains well below potential for all of these years, for this year and next year and the year after and so on, has a very large budget effect because the amount of production, the amount of taxable income is much lower for this long period. Yes.
On economic growth, your projections are considerably lower than the blue chip and Federal Reserve for 2012 and 2013, and you show growth slowing in 2013, whereas these other forecasts show it growing. And you talk about the differences in the report, including varying assumptions about continuing current policies. Can you elaborate on that?
Yes, there are several reasons why we might have different forecasts for the economy than these outside forecasters. I think the first and most important one is, as I started by saying, we're not trying to do a pure forecast. We're doing a projection based on a particular set of assumptions about fiscal policy, and in particular, that current law remains the same. If I were doing a forecast in a private capacity, I would be trying to predict the changes in fiscal policy that Congress and the President will go ahead and support. That's not our role to do that. So I think probably the principal reason that our forecast for economic growth is weaker this year, and especially next year, than a lot of outside forecasters is because we have to assume that the taxes expire at the end of this year as scheduled under current law, that all the restraints of the Budget Control Act take effect at the beginning of next year as scheduled under current law, And I think most outside forecasters, including the Federal Reserve, are making some other guess about what will actually happen to fiscal policy. There are other reasons for possible differences as well. Forecasting is a very uncertain business. But when we try to back out what our forecast might look like in the absence of this particular set of fiscal policy assumptions, we end up with numbers that look pretty similar to those that we see for outside forecasters. Yes,
Alan Sloan from Fortune. On page 124 for 2012 and 2013, are you assuming that the payroll tax holiday ends on schedule? So we would then add to that, if I care to the numbers you used before, of $75 billion for 75 for 2012 and 25 for 2013, if I were calculating the deficit.
No, so be careful here. So those who haven't found this yet, so page 124 is our projection of balances in various trust funds. I think, Alan, you're referring to the balance in the Old Age and Survivors Insurance Trust Fund.
Right.
A crucial part of the laws that have so far created this payroll tax cut, and they're being considered to extend it, is that they make up for the loss in revenue to the trust funds by putting general revenue into the trust funds. So what I've described is the effect of extending the payroll tax cut on the overall government budget, but the trust fund itself, of course, they could enact an extension that would be different, but all of the ways this has been enacted and discussed in the past have made up the difference for the trust fund.
Okay, so these non-interest differences for 11, 12, and 13 are not the program itself. It's the program plus whatever the government, the rest of the government put in.
Yes.
Thank you.
Yes, that's right. Yes.
Yeah, David Lauder with Reuters. I was just wondering if you could talk about the current fiscal year. The deficit forecast is now above $1 trillion versus just a bit below $1 trillion in your August forecast. Can you explain what the difference is there? Part of that, assuming, is payroll tax extension for a couple of months. What's the rest of it?
Yeah, so for those who want to check later, there's a table on pages 98 and 99 that decomposes the revisions to our budget projections for each of the coming 11 years. For 2012, there are a number of factors. Part of it is the extension of the payroll tax cut for January and February of this year. That was not built into our August projections. An important part of it is disappointingly low corporate tax receipts of a sort that's a little puzzling. Does not seem to be a shortfall in corporate profits as measured in the national income accounts relative to what we were expecting. Rather, it's a shortfall in the tax receipts that have been collected, essentially a decline that we weren't predicting in the average tax rate, essentially, that ends up in the corporate tax code, not the rates that are written into law, but simply the amount of revenue collected relative to the profits as reported in the national income accounts. So corporate profits taxes have been a little lower than we thought. That's another piece of this. And then there's a whole collection of other fairly small changes. The revision for 2012 is about $100 billion from what we expected in August. And that is a lot of money by many standards, but given the size of the flows into and out of the government budget, it's not a particularly striking revision.
Do you have a forecast for when the current increase in the debt limit would be consumed?
We don't try to model the cash flows on a month-to-month basis. In general terms, we think that given our projections for the deficit for the coming year, we think that the Treasury would not come up against the borrowing limit in this calendar year. But I don't know exactly. We just don't have a basis for assessing exactly when it might hit the limit. Of course, it depends, in addition to the accuracy of our projections, on what legislation is enacted, and moreover, even when a limit is reached, then, as you know, the Treasury Department has a number of steps that it takes to continue operating while remaining below the statutory limit. So, and again, we don't try to track that or predict that sort of thing. Yeah.
It's Lisa Massaro from the LA Times. I just want to go back to the unemployment rate and that spike in 2013 to the 9.1%. Can you explain the factors behind that?
So in our projection, the unemployment rate rises a little bit from here into 2013. I wouldn't refer to it as a spike particularly. Unemployment rate has been between 8.5% and 9% for much of the past few months. We do expect it, though, under current law, to move up a little in 2013, and that's because of the slowdown in economic growth, which owes most importantly to fiscal restraint. If one looks at the effects of this alternative, the differences between this alternative scenario that extends expiring tax provisions and doesn't impose the enforcement procedures from the Budget Control Act, that makes a very large difference in government inflows and outflows in the next fiscal year. And you can see some of that. And if you go to table, we have at the back of Chapter 1 some of the most, I think, important tables in the document, the effects of alternative sorts of policies. Table 1.6 shows the effects of a significant menu of alternatives that policymakers talk about. Table 1.7 pulls together the pieces that underlie this alternative fiscal scenario that we've used. So if you look at Table 1.7, for example, one can see that the difference in the deficit in 2013, and this is fiscal year 2013, between the baseline and this alternative scenario, is almost $400 billion. So the amount of higher revenues and lower spending that will occur under current law is really quite sharp. And we think that will be pushing down the economy as other factors are starting to push up the economy more. And that slowdown in growth that we see for 2013 then has an effect on the unemployment rate.
And can you divide that any further between the impact of the tax side restraint versus the BPA?
Yes, I can. So actually Table 1.6 has the pieces of that. So now again, these numbers in these tables are for fiscal years. So when we do the effects on the economy on a calendar year basis, we need to do, we take care in that. This gives you a rough sense of that. So in fiscal year 2013, the effects of extending all of the expiring tax provisions, meaning the 2001 and 3 and 9 cuts, as well as trying to index the alternative minimum tax to inflation, as well as extending the other expiring tax provisions, like the research and experimentation tax credit and other things that have been routinely extended. That set of policies together, extending them into 2013, adds about $300 billion to the deficit in 2013. At the same time, the Budget Control Act, again, to make sure everybody's understanding what I'm saying here, the Budget Control Act last summer imposed caps on discretionary spending. Then it also set up a joint select committee on deficit reduction to try to find additional savings. But the Act established a backup plan in case that committee did not report legislation, which in the end it did not. The backup plan is further cuts in discretionary and mandatory spending of the sort that are described here in the document. In Table 1.6, we show the effect of lifting those additional reductions, that enforcement procedure, but leaving in place the original caps. And that effect on the deficit in 2013 is $66 billion. And then there's also a piece, another piece of restraint is a smaller piece, is Medicare's payment rates for physicians. Beyond that, not really on a policy option, but a source of restraint in the economy is the waning effects of the Recovery Act. So most of the tax cuts and spending increases from that act are now out the door. But not all, but most. But as the effects of that wane, that is providing a further, that helped the economy before, but the waning reduces the growth rate that we'll see in this coming year. In the back.
Yes, Lester Fader with Politico. Just a question on the revisions to the projections for Medicare and Medicaid spending. You say in there that you're expecting, I think it's a $29 billion increase in outlays for Medicare and a $24 billion increase in outlays for Medicaid, but then elsewhere say that you're revising down Medicaid projections because of utilization changes. Just wondering what's the net difference in CBO's view of what's going to happen to those programs and their outlays?
I don't think I have at hand the revision to the entire stream of Medicare numbers or Medicaid numbers over the decade. Okay. We can certainly we can find those for you. It simply means taking a row and one row in one table here and subtracting a row in a table from the earlier report. I just don't have it at hand.
Do you expect that these programs will spend more than you expected in the August update, or is you?
I don't know if we've made large revisions to those projections at this point. I should say that although this is this outlook is the one that gets the most attention in the year, in fact, we get more of the data we use for updating the health projections between now and our March baseline. And moreover, we have not updated for this report our projections of the effects of the Affordable Care Act on Medicaid and other programs. We'll do that for the March baseline as well. So I think we'll actually have a more complete answer to this question in a couple of months, and I just don't know now what the revision has been. We do know, I should say, we note in here very slow growth in Medicare spending per beneficiary in the coming decade relative to what we've seen over the past few decades. And we attribute that to two factors. One of them is the restraint in payments to providers, partly from the sustainable growth rate mechanism that remains in place, partly from the additional restraint imposed in the Affordable Care Act. But the second factor that leads to slow growth in spending per beneficiary is that the Medicare population is actually getting somewhat younger over the coming decade. More people are going into Medicare, but they're going in at the age of 65. So the share of Medicare beneficiaries who are in their 60s relative to their 70s and 80s is actually going up rather substantially over the coming decade. And that means those people tend to be less expensive. So the number that we cite in the document is real growth, meaning adjusted for inflation, in Medicare spending per beneficiary has averaged about 5% a year. Between 1985 and 2007, averages about 1% a year over the 10-year projection. Yes?
John Mason with Bloomberg BNA. If I read these things correctly, which is questionable, the economic projections for 2012, both under current policy and under current law, seem to have been downgraded a little bit, and that just seems to run counter with some of this, good news we've had in the last couple of months and some of the indicators. And I was wondering if you could elaborate on why that is, or if you guys are seeing something different than anyone else is seeing. And then also, if you could comment on the impact of you guys doing the re-estimate, what that does on the timing for the President's budget, given his delay in submitting that to Congress.
Two good questions. The forecast that we published in August was essentially completed in early July. And a couple of important things happened after that we alluded to in the August report but couldn't build into the numbers. One was a revision, the annual revision to the National Income and Product Accounts that made the recent history look a little worse than it had at the time we were putting together that summer forecast. The second thing is that there was some pretty bad news late in the summer about the state of the economy. At the time that we were releasing the forecast, there were predictions by serious analysts that the country had a 1/3 chance of going into a recession, or in some cases people gave higher numbers than that. So if you look back at the period from early July to early December when this forecast was finished, the news was quite bad early and then better later. And on balance, given the way we read those data and given what we saw in this historical revision to the national income accounts, the near-term thrust of the economy looked a little weaker. And I don't think we have significant regrets at this point about the forecast we've written down. So GDP growth, as you know, in the fourth quarter looked fairly good, but much of that was inventory investment. Final sales growth, which ultimately will propel forward investment in other parts of the economy, was not particularly strong. We still see lots of problems in the housing market. Households have lost a lot of wealth. They have a lot of debt. They have a higher saving rate now than they had a few years ago, but not particularly high. And if they're trying to fortify their financial positions and deleverage, we expect more restraint from them. So I think we have good reason for expecting continued slow growth. Even in the absence of the fiscal restraint, then of course the fiscal restraint is what pushes us down to particularly low growth for next year. But as I said, this is a very uncertain business, and if one just looks at I think the swinging moods about the near-term state of the economy over the past 6 months, you can see why this sort of exercise is fraught with peril. Yes?
I think you said that there's some actions that lawmakers could take that would steer between a scenario of harsh fiscal policy leading to near recession level GDP in the near term versus better fiscal policy that leads to 96% of its debt held by the public in the long term. What are some of those policy actions that they could take that would be the exterior middle risk?
So 94%, and it's not. We have not tried to lay out a specific fiscal path. I think the point that I was trying to make, and that we've made on a number of occasions in written documents and in testimonies, is that very sharp imposition of fiscal restraint, dramatic increases in taxes or cuts in spending at a point in time, under the current economic conditions in particular, will tend to hold back the economy. At the same time, letting the debt skyrocket the way it does in this alternative scenario will ultimately be very, very damaging to the economy and unsupportable in the end. So one can both provide near-term support and put the economy on a sustainable medium-term, the budget on a sustainable medium-term and long-term path. There's no intrinsic contradiction, but to do that requires that fiscal restraint take effect slowly, but amount to a very large change from current policies by the end of the decade. This is not, as we've said a number of times before, there's no substantive advantage to waiting to decide what policy changes we will make. To the contrary, the longer that we wait as a country to make the sort of choices that we have to make, the harder it will be to make them, because more debt will have accumulated, because people will then have less time to plan how they will react to these various changes. So there's no substantive advantage to waiting to make decisions. But on the issue about how quickly those decisions should take effect, how quickly one wants taxes or spending or both to change, that's a more complicated question. And that's where you come to this trade-off, that doing it very quickly slows the economy now. If you wait too long, then you end up with debt that is much, much harder to manage. And so there are a number of ways in which Congress could put off the expiration of some of the tax provisions that are scheduled to expire, or could put off some of the spending restraint that will occur under these enforcement procedures from the Budget Control Act, but not put those off indefinitely. Or if one puts those things off indefinitely, then other very large changes need to be made in the budget. But it's not our place to recommend any specific set of changes. Yeah, Robert.
Robert here, New York Times. In the selected policy alternatives, could you make about how different the numbers would be if the continuation of tax policy, current tax policy, is adjusted so that it does not continue for people over $200,000 to $250,000? It says about $5.4 trillion is the cost of continuing.
Yes. So Robert's referring to Table 1.6 on page 19. We note that the cost of extending certain income tax and estate and gift tax provisions scheduled to expire at the end of this year and indexing A&P for inflation would have a direct effect on the deficit of $4.564 trillion and would then raise debt service by another $790 billion. And I believe it's the sum of those, Robert, that you're describing as $5.4 trillion. We don't have in this report, I think, an estimate of the effect of extending those provisions for all but the highest income people. I believe in the past, when the staff of the Joint Committee on Taxation have done estimates or proposals like that, and they're the ones who do revenue estimates, as you know, I believe their estimates have suggested that extending as a budgetary effect, that's about 3/4 or 4/5 of this total amount. So that only 1/4 or 1/5 of this $5.4 trillion is attributable to what happens to the expiration of the lower versions of this of the highest tax rates.
So the cost would be reduced by maybe 4/5. If
4/5 or 1/5?
Well, so of the total here, I think about 4/5 is the effect of extending all of the tax provisions except the rates, the highest rates. So 1/5, roughly, is the effect of extending the higher rates. And one needs to be a little careful about describing that as provisions that affect high-income people, because, as you know, people at the highest incomes pay some tax at each of the successive rates up to the highest rate. So I was trying to be careful about the wording, but garbled the key point. Damien.
Damien Flood of Wall Street Journal. Are you guys seeing any impact of the downgrade last year on the deficit over the next few years? In other words, do you factor in any kind of costs, either the debt interest payments or other impacts?
Well, interest rates, as we project them in this outlook, are lower than the rates we projected in the summer outlook. And that reduction is importantly because market interest rates have actually fallen since we produced that earlier forecast. In addition, not just current market interest rates, but the implied future interest rates that one can extract from quotations in financial markets. In addition, other forecasters, whom we look for as reference points, have lowered their forecast of interest rates. So on balance, the set of news that financial markets have seen since our previous forecast suggests lower borrowing costs, not higher borrowing costs. Now, but there are a number of pieces of news that probably play some role in that. Part is what's happening in Europe. The financial situation in Europe has clearly worsened, and I think there's much more concern about the possibility of really terrible outcomes in Europe. Part of that, I think, in the summer was concern about the weakness of the U.S. economy and what that said, not just about the demand for credit today, but the demand for credit over the coming years. Part of the news was about U.S. fiscal policy. So we don't know how to separate out the part that was due to news about U.S. fiscal policy. I think an important risk in our forecast is the possibility that interest rates will rise more sharply than we have built in here. Now, it's also possible rates will be lower than we've built in here. We try to construct forecasts that are in the middle of the distribution of possible outcomes. But these rates that we see in financial markets are a good deal lower than, again, even for the end of the decade, are a good deal lower than we would expect ourselves, given the state of the economy that we think will be in place at the end of the decade, given the demand for credit, given the fiscal policy that we see. So in that sense, we are surprised at how low interest rates are, and we take some signal from the financial markets, I think appropriately. But in countries that have had large amounts of debt and growing amounts of debt, financial markets' reactions to that can change very quickly. And if one looks at the countries in Europe that have experienced particular problems over the last couple of years, you can see very quick increases in interest rates when market perceptions turn. And I think they turn partly from numbers and partly from a sense about the ability of policymakers to address fiscal problems. It's very hard to predict when that will happen. And we wrote an issue brief years ago about the risk of a fiscal crisis. And one of the points that we made there is the uncertainty about how and when people will become reluctant to lend money to the government and start charging higher interest rates to do that. Lori.
Lori Montgomery, Washington Post. Is this the first opportunity you've had to put explicit numbers on the economic impact of the Budget Control Act sequester? And in other words, is this likely to add fresh panic on the Hill to the plane crash coming at the end of the decade?
Well, so in the summer update, the Congress had...
That was a yes or no question.
Yeah, well, I've learned a bit about this job, and I'm not giving that kind of answer. In the summer update, the Budget Control Act was passed, so its effects were built in to the budget and economic projections. But they were built in a way that, in a sort of neutral way, because we didn't know whether there would be action by the Joint Select Committee in the Congress and what it might be, or whether there would be this fallback to enforcement procedures. So at this point, because the committee did not reach an agreement and no legislation has been enacted, we've moved to following the enforcement procedures, and that's the sequestration of some mandatory spending, it's the sequestration and reduction in caps of discretionary spending. So the full flowering of that is seen here for the first time in a way it was not in August. But we've also talked about this with Joint Select Committee. We talked about it in a report we issued in mid-September. We first laid out what we thought the enforcement procedures would do. So I don't think it should be news, but it is true that it's in our outlook in this form, for the first time. Yeah.
Follow up on that question. Actually, two related questions. First of all, do you assume the automatic cuts hit OCO as well as other regular spending in our 5.0? And then secondly, can you explain why why in your alternative scenario you assume that the automatic cuts are repealed?
Yes. So the first question, just to bring everybody into the conversation, is whether there would be reductions in the funding for overseas contingency operations, essentially the war in Afghanistan and other places, we've called OCO. And yes, so the sequestration, my colleagues will catch me if I have this wrong, but the sequestration of budget authority for discretionary programs for fiscal year 2013 applies to those overseas contingency operations as well as to the rest of the budget. The OCO funding is not capped, but it is subject to a reduction. The second question, the other thing you used was the term 050 for people who don't follow this. That's a budget function for national defense, which I'm proud to say I've learned. The other question you asked was how we decided what to include in this alternative fiscal scenario. So we have for some time shown in our outlooks a menu of alternative fiscal policy assumptions so that members of Congress and their staffs who are coming themselves from a different starting point than current law can see what would happen to the budget under that starting point. I think as the last few years have gone on, and more aspects of the budget have either been enacted on a temporary basis or extended on a temporary basis, we felt that the current law baseline provides a less and less useful guide to what the current stance of fiscal policy is. So we tried to lengthen the menu of alternatives that we show because there are more and more different sorts of policies where people on the Hill will say, well, we won't do that, or I don't want this. I want to think about the budget a different way. So we've lengthened the menu. We've also tried to just pull together some of those alternative policies that many people in Congress and outside of Congress talk about as policies that, well, yes, they're in current law, but they're very different from past policies in the way that members of Congress or others don't want to have take effect. So for example, there is lots of tax provisions that are scheduled that some have expired already at the end of last year, some scheduled to expire at the end of this year, and many people on the Hill say they want to extend those policies. It's useful to see, I think, what happens to the budget in that case. For the Budget Control Act, Congress explicitly decided last summer to impose certain caps on discretionary appropriations. And then I think they decided they wanted to have a process to agree upon some larger set of changes in fiscal policy. And that process was this special committee and the powers given to that committee. But Congress also built in a sort of enforcement mechanism meant by the descriptions of people in the Congress as a sort of threat to try to propel this committee and the Congress to taking action. But I think many members of Congress don't really want those particular cutbacks to take effect. And we can see this in discussions on the Hill. People say, well, we're going to find a way to not have those automatic enforcement procedures take effect. Now, to be clear, we have no recommendation, we have no position on whether or not those things should be allowed to take effect. But in a case where a lot of our clients say they don't want them to take effect and don't want certain other things to take effect, then we think it's useful for their purposes for us to under those different assumptions. David.
I'd like to follow up on Lori's question to make sure I understand exactly what you're saying about what the economy would, how your forecast would look different if the sequester didn't take effect and the tax cuts were extended. The alternative fiscal scenario. You said that in 2013, GDP would be 2% higher.
By the end of 2013. So can I refer people to this table, and then people can look on while I try to answer David's question. So it's table 2. Let me see here. 2.2. Table 2.2 on page 30. Thank you, Kim. Yes, there we are. So this summarizes the economic effects of the policies in the baseline and under the alternative scenario. So if you look at the middle column, which is for 2013, we project that real GDP under the alternative scenario would be between 0.5% and 3.7% higher at the end of 2013. So for my comments, I just picked the midpoint of that range. We use the range deliberately because this is an uncertain business. The other thing, though, David, that I did was I talked about GNP. And I talked about GNP, which we show in the bottom row of the table. It's not much different in the near term, but it actually is a fair bit different by 2022. And this is not just an arcane matter of national income accounting. This is actually a substantive and important difference. GDP is the measure of what's produced in this country. Some of the income from what's produced in this country goes to people overseas because they have either worked here or they have sent their investment capital here. Similarly, we as citizens of this country collect money from overseas investments of ours that adds to our standard of living. So GNP is actually a better measure of the income earned by Americans than GDP is. One thing that happens if the country runs larger deficits is that the greater demand for funds or less demand for funds in total or less availability of funds to the private sector in this country draws in some capital from overseas. That enables us to keep producing, but we don't get the benefit of that. The return ultimately goes to people overseas. So when we do estimates, for example, in our long-term budget outlook of the effects of alternative fiscal outcomes on the well-being of American citizens over time, we tend to focus on GNP. So in this case, the numbers I used were the GNP numbers from the bottom of the table. And that's where you can see in 2022 a reduction in GNP between 1 and 3.7%, again with a midpoint of about 2. Actually, I'm sorry, the midpoint of that would not be about 2, would it? About 2.5%.
To follow up?
Yes.
So just looking at the out-year forecast for GDP growth, if we took our medicine in 2013, higher taxes and less spending, you're projecting a very dramatic increase in economic growth. 2014, 2015, 4% or so on average, which is pretty darn healthy. So what are the analytics behind that top and sustainability, number one? And then I wanted to ask a question about Affordable Care Act.
So on the first question, I think the way to think about it is that in the absence of fiscal restraint, if fiscal policy just were neutral over the next few years, we think the economic growth would gradually strengthen. As the effects of the lost wealth and run-up in debt weigh less on households, as the overhang of excess housing units is worked off through both greater demand for housing and the low level of construction, as businesses gain greater confidence. So we'd be looking for growth that would be picking up. The fiscal restraint is to hold that, is to offset much of that, particularly in 2013 when it takes effect. But then that fiscal restraint, the effects of the restraint wanes. I mean, it's there, but consumption has already fallen and then starts to grow again from there. So I think what you're seeing in the pop is basically just the absence, is the waning of this pressure from fiscal policy holding down growth in 2013, combined with the restorative forces of the economy that, of course, are very, very delayed in this case, but that we think will ultimately take effect.
On the Affordable Care Act, you were giving us some of the revenue and spending effects, and that you were drilling down a little bit on that. But I saw some of the tables on the surtax, et cetera, what that generates. Could you break that out a little bit more for us? Is there a change? Have you changed your assumptions and projections for, say, the spending component of this? I know you said on a per capita basis it would help to slow the growth in per capita Medicare spending, for example. Can you break that out a little bit for us? And does it net basically save the government a lot of money?
So we have not done a full estimate of the effects of the Affordable Care Act since early last year. When we did an estimate of the effects of repealing the Act. And we testified about that to the Energy and Commerce Committee in the House last March. We will, as part of our March baseline, be updating the estimates of the coverage components of the Affordable Care Act in a way that will be visible to you and others, because those pieces sort of sit somewhat separately from the rest of what's happening in the budget. The Medicare provisions, the changes that were made in the Affordable Care Act are now interlaced with the whole accumulated history of legislation for the Medicare program. So although we update those projections, and as I said before, we'll be focusing on the updating of the Medicare and Medicaid projections for March, those new projections won't automatically give us the effects of the Affordable Care Act itself, because those projections will be based on the whole sum of law that is now in place. Whether we do estimates in the future of the effects of taking out certain provisions of the Affordable Care Act and replacing them or not with certain other provisions is really up to the priorities of the Congress, and we will, I don't know if and when we'll do that. Jonathan.
You mentioned the unsustainability of the alternative fiscal scenario, and I was just looking at the phrase on page 29 about the GDP would be 2.1% smaller or 0.2% larger than under current law. That still seems to imply that we could actually run all these things and still get away with it, possibly a little bit in 2022. Can you give us some idea of whether that's the likely part of that, whether that's likely or just that's the end point of the distribution? And also, again, about the impact of the OMB delay in spending the budget.
Oh, yes, I'm sorry. Okay, so on the economic question, this is again back in Table 2.2 on page 30, the upper right corner for GDP, where we show the effect on GDP, on the output made in this country, from minus 2.1% to plus 0.2%. So what that means is that by our modeling, under certain sets of assumptions, it's possible that under this alternative scenario, GDP would be slightly higher in 2022. However, it's important to understand the limitations of that estimate. The first is the point that I made, which is that we'll be possibly producing a little more here, but a larger share of the return to that production will be going overseas. So the standard of living of Americans, which is based much more on GNP than GDP, and shown in the bottom right corner, will be down in 2022 for any of the estimates that any of the range of assumptions we use. Moreover, if the table went out further, what you would see is even that plus 0.2 in the upper right corner disappear and become negative.
There's a certain year where it would be negative on the...
Yes. And the reason for that is there are essentially two opposing forces at work here. In the alternative fiscal scenario we've outlined here, there are lower tax rates beginning in 2013 and going beyond the end of the decade. Those lower tax rates will, by our estimates, boost labor supply and saving. The opposing force is there'll be much larger deficits, and that extra government borrowing will be crowding out increasing amounts of private capital formation. And the tax rate effect, more or less constant, again, my colleagues should correct me if I had this wrong, I think it's more or less constant as a share of GDP. It's a sort of increment to the level of GDP, a little more work effort, a little more saving. It grows a little bit, but not very much. Whereas the debt is accumulating at a very rapid rate. So the depressing effects of that debt accumulation increasingly outweigh the positive effects of the lower tax rates as we go out in time. So if you saw this piece by piece, so force by force over the decade and beyond, you would see that the debt is gaining ground.
Is it fair to say, though, given that stretch between minus 2.1 and plus 0.2, that it would likely be a negative in 2022?
Oh, yes.
Okay.
Yes, most definitely. I mean, I don't know, 90% of that range is on the negative side of zero. You asked a question about timing. So what we do every spring is we work on a new baseline, our March baseline, and we do an analysis of the president's budget. in April, usually release analysis of the economic effects of the President's budget. The delay of the budget this year puts us behind in that process. Nonetheless, it is a very high priority for the budget committees on the Hill and the Congress in general for us to finish the March baseline, which actually is the base from which we will estimate the effects of cost of legislation throughout the year, and to complete the analysis of the President's budget. So we will work as hard as we can, and we hope to release both the March baseline and the analysis of the President's budget by the middle of March. But we can't be sure. We don't know what's in the budget yet. We don't know how hard it will be. We don't know what issues we'll confront in trying to do those estimates. So we work flat out during this period on this effort. And as I say, we aim for the middle of March, and but we can easily be later if we encounter more difficulties.
It's not a 1 week late means a week late means a week later for you guys getting it back to Congress.
Well, the exact timing has differed a bit from year to year, and I think it really does depend on what we find in the budget. It also depends what else the Congress is doing. If they move efficiently toward a resolution of these issues that are for which the deadline is the end of February, then that helps us. If they move there in a more rambling path, then that's a lot more work for us. And I certainly would not try to make a prediction about that.
In the campaign, there seems to be an argument that the reason the deficit's out of control is the president is spending too much. And from the White House, it said taxes on the wealthy are not high enough. And you're arguing that really the problem is the aging of the population. Can you explain a little bit more why the CBO sees it that way and what the relative weights are between those the factors that are being cited in the political realm versus what you're seeing in the demographic realm?
So, of course, I won't speak to what's being cited in the political realm, but I can. But I think if you look at the chart that's still up on the screen, you can see the basis for CBO's comments on this topic. We've clearly had a burst of spending. Spending relative to GDP has been particularly high the last few years relative to our history. And as I've said, it actually recedes a little bit the next few years under current law. But the amount of spending that was undertaken in the past few years through the Recovery Act and other legislation that's happening against a backdrop of steadily rising costs for Social Security and the major federal health care programs. And the increases in the cost of those programs are not a surprise. Analysts have been talking about them for decades. The aging of the population was pretty well foreseen. The fact that healthcare costs rise more rapidly than other sorts of things in the economy has been going on for some time. So the general contour is one that I think probably the first CBO director, Alice Rivlin, spoke about in this room. But the numbers, I think, are quite striking. Given the and I think this bar chart was trying to capture some of that. Social Security and the federal health care programs will represent about 5% of GDP more in 2022 than they have on average in the past 40 years. Maybe it's 5.5%. That's a tremendous increase for those programs. Now, the current law sets us on a path to try to offset, in a sense, some significant part of that through restraint in other programs. And the second set of bars shows how all other federal programs put together are actually set to be a significantly smaller share of GDP by the end of the decade this coming decade than they were on average in the past. And that's not. You see it across a number of programs. So defense spending, this is the alternative fiscal scenario here, so it actually takes away the enforcement procedures of the Budget Control Act. It goes back to the basic caps. But under the basic cap, defense spending would be nearly at the lowest share of GDP that has been at in my lifetime when we get to 2022. Non-defense discretionary spending will be, I think, at the lowest share of GDP it's been in my lifetime by the time we get to 2022 under those caps. All of the entitlement programs except for Social Security and the healthcare programs would be close to their smallest share of GDP in my lifetime. So there's a fair amount of restraint built in already in all the parts of the budget, all the spending side of the budget except for Social Security and the federal healthcare programs. But you can see that despite the restraint other places, total spending will still be a larger share of GDP. And that's driven by those programs. And the growth in those programs is driven by the aging of the population and rising costs for health care. So there really is a stark choice here. Even with other parts of the budget squeezed, and of course one can squeeze various things further or one can relax them more. I'm not suggesting that we've reached some limit. But given that all other federal programs together will be 7.8% of GDP in 2022, and the deficit we project will be 6.1% of GDP in 2022 under this scenario, clearly that deficit will not be brought under control without changes in at least one of revenues and Social Security and the large healthcare programs. And if one focused on trying to reduce the deficit to a manageable level in 2022, starting from this benchmark, if one focused on doing it just through tax increases, it would require very large increases in taxes. If one focused on doing it just through Social Security and the federal healthcare programs, it would require very large reductions in benefits for those programs. And even if one does it through a combination of revenue increases and reductions in those programs, the changes on both sides of the ledger would be considerable. So the gap that's opened between what we are used to getting from the government in terms of benefits per person and in terms of the operation of the rest of the government and the revenue that we're used to giving to the government has widened a great deal and is going to widen further over the coming decade. Bob.
Bob Samuelson, Washington Post. Can you just go over the Medicare spending projections again? You said earlier that your projections incorporate an assumption that spending per beneficiary would grow about 1%, I think, over the period of the projection, as opposed to the historic rate of 5%. And I'm wondering whether or not that differs substantially from your previous projections and whether the slowdown, I take the point that part of the slowdown is simply the sort of younger people coming into Medicare. But is that mainly driving this change, or is the change being driven by the recent experience when Medicare spending has been lower than expected, and also the provisions in the Affordable Care Act that mandate slower increases for some categories, hospital spending, that sort of thing?
So those are good questions which I don't have equally good answers. We've not tried to decompose this slower growth quantitatively into the two reasons I've described. We think both things are important, both the restraint in payment rates to providers and the changing demographics of the Medicare population. But I don't know how much of the difference is due to one or the other.
How does this contrast with your previous forecast?
I don't think this is much different than what we showed in August. I don't know the exact numbers from that point, but I don't think there's been much difference. Again, part of this is the restraint imposed by the Affordable Care Act. So if one went back to a projection before that, all else equal, then you would see some additional slowing from that factor. But I just don't know the decomposition and the importance of these different factors. Yes.
Just an additional question on Medicaid. One of the options that's being discussed among lawmakers for possibly dealing with the sustainable growth rate problem is using some of the savings in OCO. And I know that there were some changes in this. I was just trying to figure out the math in here and couldn't quite follow it. Even though some of that has been added into the baseline, is there still enough there that could be used by lawmakers if they wanted to offset? I think you said it was $316 billion for SGR in this update.
So I think that I'll give you some facts and then discuss the interpretation of those facts. So one fact, I think, and my colleagues will catch me if I don't have this right, is that our baseline projects about $1.4 trillion in budget authority for overseas contingency operations over the 2013 to 2022 period. Then we show in Table 1.6, the menu of alternatives, the savings from reducing the number of troops deployed for these sorts of operations to 45,000 by 2015. And there's no particular, or perhaps I should say many alternative, different sets of policy that might get you to those numbers. But that particular alternative that we show would reduce are amounts that could be used for some other purpose. Depends on just how you mean used. I mean, this is money, so the $1.4 trillion, which I should maybe explain to people, remind people, the way we do projections of discretionary spending, apart from the parts of spending that are capped now by law, is to take the most recent level of appropriations enacted by Congress and extrapolate that over the decade with growth for costs. And that was specified in law as the way we should do this kind of projection a few decades ago. So the $1.4 trillion comes from taking the latest level of appropriations, which I think were $127 billion in fiscal year 2012, and growing that with inflation. However, whether we would spend that amount or less than that or more than that depends entirely on the challenges the U.S. sees in the world and how we choose to respond to them. So whether one could enact caps, for example, on this sort of appropriation. Next time we did a base, if those caps were below the level we project here, when we did a baseline projection next time, we would show those caps. There would be a reduction in spending relative to these numbers. But that reduction might have occurred anyway without those caps, simply because we decide we choose not to fight as much overseas. On the other hand, if in fact some new challenge arises that Congress decides requires military response overseas, then presumably they would spend more than any cap that they would set in place today anyway. So, the caps do affect the projections that we make because we follow the law, but whether there are true savings there depends on what you think would happen in the absence of whatever sort of policy people had in mind.
Some people had raised concern that this update might show a significant reduction in the projected OCO spending that would therefore make it not enough funds to make up the difference for SGR. Assuming people wanted to use that kind of budget logic, these numbers don't contradict that.
No, the cost of freezing Medicare's payment rates for physicians over the decade is a little over $300 billion. So that's still a good deal smaller than our projections of the OCO funding. Other questions?
Thank you.
You ready to go? Okay.
There's one over there. Sorry.
Yes.
So with the Frank Baum Scripps Howard Foundation, with the projections of the outlays and tax cuts over the short term positively impacting economic growth, but then those things exploding the deficit, isn't it more likely with that kind of projection that Congress can give a short-term boost to the economy and then just put off the sort of fiscal restraint that you're talking about?
Well, I don't know what Congress will do faced with this information. I think we're trying just to lay out the consequences of alternative courses of action, and it's, I think, complicated in this case because current law imposes the sharp restraint that is negative for the economy in the short term, but better for the economy in the long run than extending all these expiring provisions. And that makes the job of the Congress more difficult. And we're just trying to explain the consequences of alternative courses they might take. Thank you all very much for coming.
Thank you. Thank you.
Sorry.
The Congressional Budget Office now saying that the projected deficit for 2012 will be about $1.1 trillion. You can read the entire CBO report on our website. We've linked to it. at cspan.org. Director Elmendorf, by the way, will be testifying tomorrow before the House Budget Committee. We'll have live coverage of that beginning at 10 a.m. Eastern. That'll be on C-SPAN 3 and also on C-SPAN Radio.